Imagine this. You finally managed to save $1,000. It might have taken you a few months or maybe even a year. Either way, this $1,000 represents discipline, sacrifice, and focus. Now comes the big question. What should you do with it? Do you leave it sitting in a bank account, earning almost nothing? Do you spend it on things that feel good for a moment? Or do you invest it and start building real, long-term wealth? Most people think investing is something only rich people do. They believe you need tens of thousands of dollars or a finance degree to start. But here's the truth. Your first $1,000 can be the most important money you ever invest, not because it will make you rich overnight, but because it starts the habit of investing, which is far more powerful than the amount itself. In this video, I'm going to show you exactly how beginners can invest their first $1,000 in 2026, including beginner-friendly options, tips, and how to decide between index funds and individual stocks. By the end of this video, you'll know exactly how to take that first step, and more importantly, how to keep investing consistently. Before we talk about the how, let's first talk about the why. Keeping money in a regular savings account is safe, but it grows very slowly. Many banks today offer less than 1% interest per year. Meanwhile, inflation is rising steadily, making everything from groceries to rent more expensive each year. This means that if your money just sits in a bank, it's actually losing value over time. Investing changes that. When you invest, your money starts to work for you. Over time, it grows faster than inflation. For example, the U.S. stock market has historically returned about 8 to 10% per year on average. That might not sound like a lot, but thanks to compound growth, small amounts of money can grow exponentially over time. Compound growth works like a snowball rolling down a hill. At first, the snowball is small, but as it rolls, it picks up more snow and grows larger and larger. Investing works the same way. Your money grows, and then the growth itself starts generating even more growth. Let's do some simple math. If you invest $1,000 today at an average of 8% per year, after 10 years, roughly $2,150. After 20 years, roughly $4,660. After 30 years, roughly $10,000. Now imagine if you continue to invest a little each month. That small monthly habit multiplies your growth significantly. This is why starting with your first $1,000 is so powerful. It teaches you the habit of investing and starts your money working for you. Here's something most beginners don't realize. The biggest mistake is trying to pick individual stocks too early. Many beginners hear about a stock trending on social media or a hot company in the news and think they've found the next Tesla or Amazon. The truth, even professional investors with massive research teams struggle to consistently pick winning stocks. Trying to pick the next big winner is risky. One wrong choice, and you could lose a significant portion of your money. Instead, beginners should focus on something simpler, safer, and more reliable: index funds. So what exactly is an index fund? An index fund is a type of investment that tracks a group of companies instead of just one. For example, the S&P 500 Index Fund invests in 500 of the largest companies in the United States, including big names like Apple, Microsoft, Amazon, Google, and Nvidia. When you invest in an index fund, you're investing in the overall market, not betting everything on a single company. This approach is powerful for beginners because it provides diversification, meaning your risk is spread across many companies. If one company performs poorly, the others help balance your investment. Even legendary investor Warren Buffett recommends that most people should invest in low-cost index funds rather than trying to pick individual stocks. Now let's get practical. Here's exactly how you can invest your first $1,000 in 2026. Step 1. Open a brokerage account. A brokerage account is an online platform that allows you to buy stocks, ETFs, and index funds. Beginner-friendly platforms include Fidelity, Vanguard, Charles Schwab. These platforms are easy to use, have low fees, and allow you to start with small amounts. Step 2. Choose your investment. For beginners, the safest and simplest option is a low-cost index fund. Examples include S&P 500 Index Fund, Total Stock Market Fund. These funds automatically spread your money across hundreds or thousands of companies, reducing risk and giving you exposure to the overall market. Step 3. Invest your first $1,000. Once your account is open, choose the fund and make your first investment. Don't overthink it. The key is to start now, not wait for the perfect time. Step 4. Stay consistent. Investing isn't a one-time thing. It's about building a habit. Consider adding a small monthly contribution. Even $50 to $200 a month can make a huge difference over time. Step 5. Ignore short-term fluctuations. The market will go up and down. Some days your account may lose value. This is normal. Focus on long-term growth and avoid panic selling. Here's the thing. Your first $1,000 probably won't make you rich by itself. The real value is in starting the habit. Once you start investing, your mindset changes. You begin thinking differently about money. Instead of spending everything, you start building assets. You focus on long-term growth instead of instant gratification. You learn patience, one of the most important skills for investors. Many investors say the hardest milestone is reaching the first $100,000 invested. After that point, compound growth begins to accelerate dramatically. But every journey starts somewhere, and for many, it starts with just $1,000. To make your first investment count, follow these beginner-friendly tips. Keep it simple. Stick to index funds over individual stocks. Stay consistent. Invest regularly, even small amounts. Ignore noise. Don't panic over daily market movements. Track progress. Use a spreadsheet or app to monitor growth. Educate yourself gradually. Learn step by step. Don't try to know everything at once. These tips will help you avoid mistakes that derail many beginners. Let's put this into perspective with a real example. You invest $1,000 today in an S&P 500 index fund. You add $100 per month for the next 10 years. Assuming an 8% annual growth rate, after 10 years, your investment could grow to roughly $18,000 to $20,000. Now imagine doing the same for 20 years. It could grow to over $60,000. This shows how starting small and staying consistent builds wealth over time. So if you've been waiting for the perfect time to start investing, remember this: there will never be a perfect time. Markets fluctuate, economies change, life throws surprises, but the one factor you can control is when you start. Start with your first $1,000. Open a brokerage account. Choose a beginner-friendly index fund. Invest consistently and stay patient. Your first $1,000 might feel small today, but it's the foundation of your financial future. And if you want to learn the next major milestone in investing, check out the video on your screen about why the first $100,000 changes everything. Time is your most powerful ally in investing. Start now and give your money the chance to grow.